Now, a lot of discussion around what's happening with the overnight rates. What is your take on how some of these CBN directives and, of course, the MPC decision is impacting our markets?
Hi, Uche. Well, what we've seen today is a perfect storm of events where you have the CBN decision taken, I think, sometime last week, combined with several things that happened today, and I'll explain this. To start with, we have a WDAS auction, which is where the CBN sells foreign exchange. All the banks want to go for that, and because they can't borrow from the CBN window, that money has to be raised in the market. Secondly, we have a treasury bill auction, which is funded value today. Effective date is tomorrow, but the accounts have to be funded for that. That's the second thing. Then you have two things that happened last week. You have just like you said, MPC took a decision, cash reserve ratio has increased. That has to be complied with. That's an extra 3%. It moved from 9 to 12. That's an extra 3%. And then you top it all with the fact that you cannot take funds from the CBN window, and you understand why we have those kind of rates. In fact, from what we've been able to check, we've gone to have a look at some of our records, and we think that we haven't seen rates as high as this since 2006, September 2006. So that's like we're at 6-year highs. At least that's what we can find from our records.
And certainly, Kubi, there's a serious lack of liquidity in the markets right now. But looking at the WDAS auction and what was offered today, we saw the CBN offering about $318 million, their highest since, I think, June. Now, this new directive, we're saying that banks actually cannot access the WDAS auction and the standing lending facility at the same time. It seems to have had a huge impact. Now, how did you see it impact offers in terms of the WDAS auction today?
Well, as you said, that's actually the highest on offer and the highest sold since July 2nd. So we're talking about more than a month. And the fact is that banks have had to fund this one way or another. They've had to fund it, by raising money in between themselves. And that's why we have this kind of rates we're seeing. We actually, I think 32, 34, we didn't see any 37, but we've seen as high as 34% today, effectively. And of course, that's what we will expect in such a situation. It won't have a direct effect. The point is nobody wants to lose their WDAS bid. So it won't have a direct effect on demand, but it will certainly affect the local currency, the local interest rates, and that's what we've seen today.
Now, somebody did mention to me earlier that these are the rates that you see usually when banks are in distress. So, I want to ask on the side, there must be some big winners today. For those banks who actually are liquid, somebody must be making a killing today. What's your take on that?
Yes, definitely. If you're on the placing side of that, you will be making a killing. I wouldn't say banks are in distress. I'll say that the market was given a very short time to comply with a significant difference in rates. We had more than 500 billion sterilized from the system last week for the cash reserve ratio. There were 2 days to comply. It wasn't like we had a month in which to plan liquidity. So, of course, we've had to adjust to that very quickly. What will happen as the month goes on is that liquidity will come back in. There'll be treasury bill maturities. We have maturities of about 100 billion in 2 weeks' time. So some banks will use the opportunity, allow some bills to mature, money will come into the system. And then, of course, we have the normal monthly statutory flows. So things will ease up. Maybe towards the end of this week, next week, it will be a bit easier, but certainly conditions are going to remain tight.
Well, Kubi, certainly you mentioned one of the components of this perfect storm that's sort of brewing is the fact that we had a TBill auction today. 141.1 billion naira actually being auctioned by the central bank. Do you have any news on the results? And if not, what were your expectations?
The results just came out and pretty much as expected. 91-day bills, I think about 14.5. 182-day bills have crossed again to 15% levels, which is what we expect, at 15.3. And then the 1-year bills, 15.38. There tends to be a lot of demand at the longer tenors, which is why you see the 182 and the 364-day rates to be pretty similar. So, of course, as we expect, yields have moved up, and we think they're going to continue moving up, especially towards the end of the month when banks have to simply reduce their demand at the treasury bill window and have, increase the cash that they're holding.
Well, thanks, Kubi. But I'd like to ask your thoughts on the planned $600 million dollar bond that the federal government is planning to issue. Now, there's been a lot of discussion around how wise is this? Should we increase the level of international debt that we have? Now, what are your thoughts on, of course, how it will perform first and foremost?
Well, prior to now, there have been a lot of talk, there's been a lot of noise, I'd say, around the amount of local debt that the government has been carrying and the the cost of servicing that, which, as we've just said now, is roughly 15%. So if you look at that against a Eurobond, the rates will be much lower. They'll be single digits, maybe 6-7% at the very most. So obviously it will be cheaper for the government. And another comment we've heard all year is that the external debt for the government is very low. So, maybe they want to change the mix a bit. It's something they can afford. If you look at our basic source of foreign exchange revenue is oil, and oil production is probably at an all-time high, close to 3 million barrels a day. So it's something that I think we can sustain, and it will bring down the cost of borrowing significantly for the federal government.
Well, we're also hearing that the federal government's debt is decreasing. Well, the amount of debt that they're putting out there is decreasing. As of June, it was at 16.5% of 2011 GDP. Now, what are your thoughts on how this is going to affect our local secondary markets?
Well, yes, it's been decreasing, which is the whole idea. Bring down the cost of borrowing and then bring down the overall amount. For the local markets, yeah, there'll probably be smaller volumes. For other banks that are floating Eurobonds, probably float on the back of what happens at the FGN bond market. So I think that's what we'll be seeing going forward.